Hey guys, welcome back. So yesterday we received employment numbers that were better than expected, and that led to headlines that said interest rates are now on the rise. And so over the last couple of weeks, Josh and I, Buywise Mortgage, have been discussing interest rates. We've discussed all things mortgage related and how they tie into real estate. And with that, we've been talking about refinancing. Should you take advantage of rates where they are now? Are rates going lower? And so with these new headlines out as of yesterday saying that rates are on the rise, I thought it would be a good idea to bring Josh back in to say, to tell us what that actually means, right? Because there's a lot of clickbait out there. There's a lot of stuff to get you to just click on an article so that, people make small pennies here and there. But what's the reality behind the employment numbers? I mean, are the employment numbers even real, right? So that's what we're going to talk about today. But before we dive into it, my name is Jeb Smith. I'm a real estate broker here in Southern California. And we appreciate you taking the time to watch. If you're new to us, it's all about real estate, all about mortgage, all about finance, and helping guide you through that process. So we appreciate you watching. We appreciate your support, and subscribe if you want more information along these lines. So Josh, you heard what I just said, right? I mean, we actually had a conversation last night where we were discussing, employment numbers, right? They came back way better than anyone had expected. There's a lot of talks out there right now, or have been over the last couple of weeks, about a V-shaped recovery, right? So the market is essentially going to go up back to where it was as quickly as it came down. And a lot of, what we're seeing is supporting that. But we're here to talk about interest rates. And so with the employment numbers, what actually happened with rates? Because what I read is said that interest rates were on the rise.
So one of the big reasons why there's so much in the headlines just this week on the employment figures and how it's impacting interest rates is due to government intervention. Since the coronavirus stuff jumped off, rates have gone nowhere. They've been incredibly flat. So Treasury's mortgage-backed securities have sold within a very narrow range for going on 70 trading days now. So way back to the beginning of March. This week was the first sort of shock or surprise news. And it finally moved the markets, and it moved them out of the range they've been in. Treasuries are higher. We're up about 0.9% when we've been in the range from 0.65 to 0.7 on the 10-year Treasury. And mortgages did bump, but let's talk about that and what it actually looks like. So the employment figures, ADP about 3-4 years ago decided. So ADP is a big payroll provider. They said, hey, the monthly jobs report is a really big thing. Well, we actually have an interesting look into that data because we're the biggest payroll provider in the United States. Let's make sort of a metric off of our payroll, what we're seeing. We'll release it 2 days before the actual Bureau of Labor Statistics comes out with their monthly employment report. And they kind of get some headlines, and people keep ADP's name in the news. So their figures came out Wednesday, and that was a really big shock. They were predicting 8 million jobs lost, and there was only 2 million jobs lost according to their metrics. So then people flash forward, go, okay, Friday we got a jobs report coming in. Are we going to have a pleasant surprise, meaning not nearly as many jobs lost as what people thought? There were 20 million jobs lost the prior month. So the expectation is if we're in the 8 or 9 million range, we're trending the right direction. Actually comes out and they announced 2 million jobs created, none lost. So in the context of what the markets are looking at, markets are always buying the rumor and selling the fact. So they're looking forward of what's happening. So largely what we see is no one knows what in the heck is going on. There's a household survey and there's a business survey that the Bureau of Labor Statistics does. There's some sort of wiggle room in there, and there's some adjustments. And currently when they do the household survey, they actually call, I think it's 100,000 households and do a phone survey. Are you working? Do you want to work? And the way they're able to report it right now, it actually understates unemployment by about 3%. So without going too deep into that, we're expecting another really bad jobs report, better than last month. And it actually ended up a ton better than expected. Now, in context, if there really were 2 million created this month, there were still 20 million lost the month before. So in the last 2 months, we've lost 18 million jobs. We're also seeing continuing claims really high. So all that is to say, what does it mean for interest rates going forward? Well, what it means for interest rates right now is traders on Wall Street, the Chicago Board of Trade, buying treasuries, buying mortgages, said, maybe the economy is going to recover better and faster than was previously expected, and maybe these low rates are not necessary. So the important thing is that we broke out of that range that we were in for about 70 days. On mortgage-backed securities, we lost the 25 and the 50-day moving average. You don't need to know what those mean. Those are technical indicators. Right now, the fundamentals, the news of the employment report are less important than the technicals, especially for anyone in the mortgage market, because in the short term, technicals are a better tell of what's going to happen in the short term than fundamental news, which will dictate over the long term. But right now, rates are maybe up 0.1% over the last week. So the actual move higher in interest rates isn't as important as just the thought process or the knowledge to people who want to refinance. If you're going to buy, you're going to buy when you find the right house, and rates are going to remain low. But if you're looking to refinance, we've talked to a lot of people over the last 2 weeks. They're like, I'm going to wait and see if they go lower. And what you and I have been talking about here every week on our calls is, if the numbers make sense today, we're at an all-time low. They've never been lower. If the numbers make sense today, it's kind of foolish to say, I think they might go lower. I can give you a really good argument why I believe they're going to. I don't think it's going to happen in a week or two. It's going to happen over the next 12 to 24 months. There may be another opportunity. But to put it in context, Jeb, of what does it mean? Where are interest rates? A conventional loan, non-high balance, under 510, 400, still right in that 3.25 range with 0 points. So it's up a tiny, tiny bit over last week. FHA and VA are up a tiny bit at about 3%. Now, the most interesting thing that happened this week in relation to interest rates is one of our lenders has gotten really aggressive. So we've also talked about high balance loans, anything over 510, 400. They have not been nearly as aggressive. We're seeing those margins get narrower over time. But on the FHA and VA, we have one of our investors jump back in this week, and they're where we see historically. Usually the high balance loans, 510, 400 and above, are about 0.8% higher than the standard balance, and they're right there on that range. So if we've had people that have been holding off or not seeing the numbers they like on the high balance stuff, that is looking much more attractive. The conventional is still probably about 0.25% higher versus that standard 8 that we see over time. But long way of saying, the important part we had talked about, we see a spread between the 10-year Treasury and mortgages is usually over time averages about 1.7%. So if the 10-year Treasury was at 0.65, we would have expected mortgage rates at 2.35. Instead, they hit all-time low at around 3.25. So a long way of saying, even if Treasuries go up, we have a lot of wiggle room in there. Lenders are getting more comfortable that with what their forbearance risk is, with what the risk of new loans going on the books of people that might lose their jobs, strong employment figures, we're likely to see that. So we had peaked at about a 2.7 spread between Treasuries and mortgages. We're down to about 2.4 right now. So Treasury could go up 10, 20 basis points, and lenders could easily absorb that within their historical margins. So for that reason, I don't expect rates to spike, but it definitely looks like for the short term, we've seen the lows in interest rates.
No, got it. And so you mentioned something there that I also read a headline on that kind of takes me into something I want to talk about here is you said lenders are getting more comfortable, right? So I saw something this week, and we've talked about UWM in separate videos and what have you, but they came out this week, and they've now said that additional requirement that they were having with regards to verification of employment at close of funding has now gone away, right? Yeah. So does that mean like lenders are getting a little more lax on guidelines, or, I mean, not lax, but back to where we were 2 months ago? I mean, is that what we're seeing more of?
Much closer to back to normal. So UWM was the only one that had added the additional policy of verification right before docs go out, and then again before your funding wire goes out, before they wire your funds to escrow, and they eliminated that. But every day for the last 2-3 weeks, we're getting updates from lenders saying, hey, this COVID overlay is going away. This COVID overlay is relaxing. So really good borrowers, I shouldn't say good borrowers, everyone's a good borrower. Borrowers with credit scores above 680 are seeing very few COVID overlays anymore. We still have some from that 640 to 680. It's still difficult for anyone under 640 to get decent terms and participate in the low interest rates. So yeah, it's absolutely getting better from that perspective. Really, the only people that are seeing a big change are the self-employed borrowers, just because it's much harder for a lender to get a handle on how their cash flow and their net worth, how their balance sheet has been impacted by the shutdown and downturn in business.
No, and the last thing we'll touch on here, just on that self-employment thing. So, we talked about self-employment guidelines a couple of weeks ago in video. It might have been last week. I'm losing where we are in this whole cycle. But, what I've heard is not only are those measures in place from Fannie and Freddie, but a lot of these lenders are actually adding their own overlay on top of that whole self-employment thing, which is making it even, if you just looked at Fannie and Freddie's guidelines alone, that looks like it's pretty difficult to make sense of just in being able to verify income and what have you. And now you've got lenders adding additional overlays on top of that, which, it makes it difficult for self-employed borrowers, at least for now.
Yeah. The guidelines absolutely vary from lender to lender. What Fannie and Freddie put out is going to apply to any lender you go to, but still lenders are adding their own twist on it, a little more, a little less. For us, we're a broker. We regularly deal with 15 to 20 lenders. So a lot of times it's not just shopping for interest rate or terms, it's shopping for, hey, we have this scenario for this borrower, whose box does it fit in?
No, and that's actually what I was going to say, right? So a lot of these people out there don't know that I actually have a mortgage brokering background, right? So I was in the position that you're in for over 10 years. And that's the thing. That's the plus about going to a mortgage broker versus, say, a traditional bank, right? You have access to programs and different guidelines that say, if you go to your traditional bank, they may not offer. So, if you're in that world and you're looking for the best terms, the best rate, all of that stuff, make sure that one of your options is somebody that's a broker, because they do have access to more of this stuff. So, I had to ask you a question, but we'll leave it for next time, next update we do. And that's, it looks to be that not only the mortgage forbearance that's out there has caused issues with regards to refinancing and purchasing. Now, Fannie and Freddie have since done changes to their guidelines to allow that to take place. But again, we talked prior to this that now it sounds like if you did a forbearance on, say, a student loan or a car payment or something else, that may have an effect on your ability to refinance or purchase, right? And I'll leave, everyone with that's what we're going to talk about next time, because I think it's going to be a long conversation. And in lieu of keeping this video short, I just wanted to get the headlines out there now. So in layman's terms, Josh, rates, if you're considering purchasing, refinancing, taking advantage of the market, a bird in the hand is worth two in the bush, right? You should pull the trigger if it makes sense now.
Absolutely. Have someone walk through the numbers, give you a thorough analysis of what you're saving today, what, if anything, you're adding to your loan balance, what it's going to look like 3 years from now, what it's going to look like 10 years from now. So if you're talking to someone and all they want to give you is rate and payment, or, hey, here's your rate and here's what your closing costs are, you need to look at the thorough analysis of everything over time. Because for the most part, 70–80% of borrowers can benefit from the current interest rates. So you owe it to yourself to check it out and talk to an expert that can actually present your options to you.
No, agreed. So we're going to leave it there. This is our shortest one yet. So, as always, we appreciate you guys watching, your support. If you have questions for Josh or myself, do me a favor, comment below. And if you have videos you want us to touch on, whether, with regards to lending or how it relates to real estate or any of that stuff, again, reach out to one of us, like a lot of you guys have, and we will be sure to do that for you. So as always, thanks for watching, and we'll see you again next time.